Greetings and welcome. My name is Eliot Bishop. I'm a portfolio strategist at Hennessy Funds in Novato, California. Today's short podcast called Viewpoints by Hennessy will cover the Hennessy Cornerstone Mid Cap 30 Fund. And here today to help me with this discussion are Kelley and Josh Wein, portfolio managers for the funds. Gentlemen, thanks for joining me.
Thanks for having us.
Thank you. Thanks, Eliot.
So Ryan, I'm going to pick on you first. If you don't mind, there might be some folks joining us that are newer to either Hennessy Funds or this investment strategy. Could you please quickly just cover the investment philosophy and the portfolio construction process?
Absolutely. So this portfolio, what we're trying to do is we're trying to provide investors with a concentrated portfolio of mid-cap and smaller cap companies using a time-tested formula, which is based purely on company fundamentals going back for many years. This style of investing is called fundamental quantitative investing. It was written about by James O'Shaughnessy in his book called What Works on Wall Street. The focus is on what's worked over time, not necessarily what the current latest and greatest is, or trying to figure out the next hot industry or whatever sector might be next up as far as outperformance goes. We use a simple formula. This process remains consistent and repeatable, and it eliminates the blunders of emotional investing. And it's been very much the same since we first started the fund back in 2003. The strategy is to combine earnings growth, sustained momentum, and low valuation in order to find high quality companies that may be undervalued. So I'll describe the actual formula in detail, which is not actually that long. It's also disclosed on our website. It's on our fact sheets. It's in all of our filings. And that'll give you an idea of what the construction is all about. We start with a universe of all U.S. equities. We then look for market caps between 2 and 25 billion. And one note here, this has changed most recently in September. It used to be 1 to 10 billion, and now we're using 2 and 25 billion. We look then out of those companies that are left, we look for price to sales ratio of less than 1.5 times. We're looking for annual earnings higher this year than last year. And we're looking for stock price appreciation over 3 and 6 months. We then take whatever's left, and at that point, there's somewhere around 120 companies. And we're looking to build a high concentration portfolio of just 30 stocks. So the 30 stocks that have the highest 1 year price performance become the 30 stocks that are in the portfolio. We do this once per year, which we just did in September. And when we first implement it and we first do all the trading, we bring in all the new companies, take whatever's left over as well, some of the keepers, and they all start the year at about a 3.3% weight. So it's equal weighted at inception.
Well, Josh, I'll ask you this next question, and I brought with me a fun little prompt here. So this massive brick of a book is called What Works on Wall Street, and it's actually the James O'Shaughnessy book that Ryan just mentioned. And within this book, obviously the price to sales metric becomes a really important talking point throughout about the potential benefits for investing in stocks that have lower price to sales ratios. So can you just expand a little bit more on that for us?
Sure. Yeah. Price to sales definitely not only differentiates the fund, but certainly has been, I think, one of the leading reasons why the fund has done well over a long period of time. First of all, as far as I know, Hennessy, the Mid Cap 30 Fund, as well as our Growth Fund, are the only funds that use price to sales as a key valuation metric. And I think it's important for a couple of reasons. First of all, focusing as many do on earnings and PE, makes sense on the surface, but you're certainly excluding companies that are unprofitable that would not have a PE. And I think second of all, within that, you're capturing companies that are either cyclical in nature and are about to start doing well again after a period of underperformance, or even just capturing turnaround stories, which this fund has certainly participated in on occasion. Getting more down to the use of it, our metric is less than 1.5 times sales. And, so it's very restrictive. It tends to bring in, as is the case now, post rebalance, it brings in lower margin, more defensive companies and sectors, things like consumer discretionary and industrials.
And then Ryan, I wanted to just kind of go back to a point you just made. So in the last few weeks, once we announced this change to market cap coverage for the strategy, I've actually had some really great feedback from some of the advisors who have larger investments within the Mid Cap 30 product. Can you just expand a little bit more on some of the considerations that you and Josh and Neil Hennessy had to take a look at before announcing this change?
Sure. I mean, as you mentioned, it just in many ways makes sense. Overall, market caps have moved up since its inception. This fund was first inception date is back in 2003, so it's almost 22 years old. Certainly during that time, market caps overall have moved up in whatever part of the market you're talking about, small, mid, or large. We started with the 1 to 10 billion in market cap range that covered about 90% or so of what you would consider mid caps back then. The move now, the idea is that we're trying to do the exact same thing and still have a good opportunity set for investors and make sure that we're looking at the effect of this change on potential performance, but also being realistic in where market caps are at this point in time. We found that in moving the range from 1 to 10 billion up to 2 to 25 billion, we not only opened the fund up to more mid-cap companies as they are today, but we think that we've also augmented the opportunity set of investments for the portfolio. In addition, when we move the lower end of the range from 1 to 2 billion, that helps in many ways, at least for those smallest companies that are in the fund, to reduce trading friction. It allows the fund to invest more in those smallest companies in the fund. And overall, it improves overall liquidity.
Thank you. Josh, I also have a kind of a follow-up question around the rebalance. So since the new holdings will obviously be in the fund for the next year, I was hoping you might have just a couple comments for us around the new composition of the portfolio.
Sure. Yeah. So now post rebalance, we tend to be top heavy in terms of sector allocation. So the top three sectors account for about 74, almost 75% of the fund. So industrials are about 35%, consumer discretionary about 25%, and information technology about 13 or 14%. And that tends to be a typical makeup of the fund. As I mentioned earlier, the methodology, the rules-based methodology does tend to lead us toward companies in industrials and consumer discretionary that do tend to have lower margins. Just more, granular in nature, I would just point out that the industrials allocation is up a good amount from last year. The consumer discretionary allocation down a little bit. And more notably, or most notably, information technology is up quite a bit from last year. We tend not to own a lot of information technology companies. When we do, they tend to be more on the distribution and contract manufacturing side, very much in keeping with prior years' portfolios in terms of how we're spreading our bets.
Well, so what I did notice in the portfolio is that Cheesecake Factory, ticker CAKE, is actually moving from last year and staying in the portfolio through this next year. I got to tell you, it's actually one of our family's guilty pleasures. I have two boys, 16 and 13, and they love that dessert menu. But past the large dessert menu, there have to be some other elements to that stock from a fundamental standpoint that kept it in the portfolio going forward.
Yeah, absolutely. And it's interesting because Cheesecake Factory, remains in the fund, and it's very emblematic of what the fund tends to look like over time, which is a lot of, well-known brand names that used to be very, very hot. And I think people forget about, at least in the investment community, but they're still around and alive and kicking. So, Cheesecake Factory, is still growing at a decent kind of high single-digit clip in revenue and earnings, and strong returns on equity. It's still a very vital company. Certainly doesn't get any of the same kind of attention that it used to in the 90s when they were opening up, near or in every mall in America. But yeah, they're still alive, and names like that have really provided the fuel to the fund.
And then, Ryan, Josh actually just mentioned the tech exposure in the fund. And I know that this has been historically for this product something that we've seen, I think, pretty much year in, year out, which is a smaller allocation to tech. Can you talk a little bit more about that trend?
Yeah, absolutely. So after this year's rebalance, as of September 30th, we have about a 13% exposure to tech, which is higher than normal for this fund. Also slightly overweight the Russell Mid Cap Index, which is about 12%. But as Josh mentioned, these are more of your sort of lower margin distribution, those types of companies. We have companies in communications equipment, electronic manufacturing, and distribution sub-industries. By nature of the formula itself, we tend to end up with these lower margin companies. But of course, they all are trading at a pretty low price to sales, so at a pretty attractive valuation. One thing to point out about this fund and the mid-cap sector, or the mid-cap space itself, is that it has a much lower exposure to technology than large caps. The Russell mid-cap is only 12%, as I mentioned. The S&P 500 right now is 35% of the S&P is information technology companies. But we've had good performance over the years. Inception to date has been pretty compelling. It's a testament. This fund is a testament to the fact that you can have really good performance without owning the Magnificent Seven and without owning the mega cap companies out there, the mega cap tech companies. And certainly, we'll wait and see how these particular tech stocks do this year. But, that's just something I wanted to make sure to point out to investors.
And then, Ryan, since you are CIO here at Hennessy Funds, I thought I should at least ask, when you take a look at the composition of this fund for the next 12-month cycle, anything going into the end of the year here or early next year in terms of just common market themes that we believe that the fund is positioned nicely for?
Sure. It's a hard question. Obviously, it involves crystal balls. But I first would want to point out that stock selection is the primary driver of this fund for outperformance, not necessarily sector allocation or being in the right place at the right time. Indeed, when you look at the last 5 years of relative performance versus its benchmark, 75% of the fund's outperformance has come from the stocks we actually own, not the sectors that they are in necessarily. That being said, yes, let's take a look at what we have right now. We're overweight positions in industrials and consumer discretionary, as Josh had mentioned. About 18 of the 30 holdings are in those two sectors. We think that this economic environment, characterized by solid consumer spending, low unemployment, potentially continued declining interest rates, could help to boost up consumer discretionary stocks, while construction in U.S. manufacturing, build out of data centers and related infrastructure for AI and cryptocurrencies should continue to boost some of our industrial companies as well. On the flip side, and just with market valuations being pretty high, and the fact that the market can't go up forever, if there is a potential for a pause or a slight downturn, this fund is usually well positioned for those, just given the fact that we do have such a strict valuation metric that helps to protect on the downside. And when we look at the 5-year downside capture ratio, for instance, it's at 78%. During that same time, the upside capture ratio is 113%. So generally, this fund has protected investors when the overall benchmark or the market takes a pause, but also the fund does well on the upside as well.
And then, Josh, we'll wrap up with you. If I'm a financial advisor and I want to present this strategy or talk about this strategy with a client, what are some of the key things that you'd want them to mention?
It's a great question. It's a great way to end. Well, first and foremost, the fund has needless to say, a very strong long-term track record. And more importantly, the strategy has remained the same. So Ryan and I are not tweaking the parameters. We are not overriding them or second guessing. I think as a result, we sleep well at night, regardless of the market environment we're in. But I think drilling down, more practically speaking, it's a way to diversify both strategy and holdings for a client. So the strategy being, and as we spoke about, price to sales. It really is a unique way of looking at the investment universe. I think nearly all managers are looking at price to earnings, price to cash flow. That's great, but I think looking at things on a price to sales basis is certainly a unique way of viewing the world. And then also, we don't own the Magnificent Seven being a mid-cap fund. We also don't own stocks that are trying to be the next Magnificent Seven. So I think that's a virtuous, certainly at this point in time, where a lot of these large cap tech stocks and mid-cap are priced maybe not to perfection, but pretty near it. A lot has to go right, and it might, but it also might not. And I don't want to be around when the party stops. So I think that the fund certainly plays a key role in a client's kind of overall fully allocated portfolio for diversification reasons.
Well, gentlemen, I'd like to thank you both for joining me today. And for all of our viewers, if you need any more information on Hennessy funds, either this particular product, the Hennessy Cornerstone Mid Cap 30 Fund, or any of our other products, you can go to hennessyfunds.com. And again, I hope everybody has a wonderful day, and thanks for joining.